Kitco Mining's special coverage of resourcing tomorrow is brought to you by Aris Mining.
Is gold breaking out? This is Paul Harris for Kitco Mining at Resourcing Tomorrow in London. And joining me to discuss this today is Christopher Ecclestone, mining strategist at Hallgarten Company. Chris, welcome back to Kitco.
Hi there, thank you.
Now, gold seems to be breaking out above $2,000 per ounce. Will it stick, and what does it mean if it does?
Will it stick? What's driving it? We have to look back at what's potentially driving it. Most of the move in recent times has come out of the Middle Eastern conflict, which really has had no economic effect on any part of the world except probably the Israeli economy. So why has it gone up? Because people thought it was going to get a lot worse. Now, we don't know whether it's going to get worse or not, and I'm not in the punditry game as to work that out. But it's definitely been the motor of the latest move in the gold price. It hasn't been inflation because, as we know, inflation came and it didn't move the gold price. And now inflation is, if not back in its box, it's sort of stabilized. So there's no reason to storm into gold on inflation fears if the inflation fear is now being mitigated.
Okay, well, let's switch to copper. Copper's had a more difficult time of things. The copper price has been quite stable or has plateaued this year around sort of $3.60, $3.70 a pound. Why isn't copper breaking out?
Well, you've got the fundamental supply and demand situation, particularly the demand situation, that you've got a sloppy Chinese economy and you've got unexciting Western economies, so there's not more demand. On the buzz front, of course, you can live by the battery metal story and die by it as well. And copper has been brutally pumped, at least on the airwaves, by many people in the battery metal space and in the copper space themselves, clutching onto the story that there's going to be some enormous wave of extra unsatisfied demand for copper coming from the battery metal and the EV sector. And there may be, but it's not here yet. And if anything, we're starting to see that many of the projections in that sector of straight lines to the moon are not panning out that way. We've got poor sales in China of EVs, and we've got large areas of the world that have zero adoption of EVs and showing no signs of adopting them either. And you've also got a situation where in certain markets, particularly the very important US market, while in some states there may be a gun against the head of the consumers to convert, many states no. So copper promoters should not have really grabbed onto battery metals and made copper all about battery metals. Because for me, the story with copper was chronic underinvestment since the late 1990s means that we don't have enough mines for satisfying demand, even without the EV story. You don't need the EV story to make copper look good.
Well, that's still the case, isn't it? The basic economic growth is going to add a lot to copper demand. And as you say, the investment hasn't been there on the production side to keep up with that.
Absolutely. So there is a shortage or a gap coming down the line because, we've got big mines that no one's finding big mines like that anymore. Oyu Tolgoi in Mongolia was like the last mega mine that was found. From here on out, it's going to be mid-sized mines with lower grades. So it's going to be a lot harder to satisfy that demand. So there's going to need to be rationing, and rationing is sometimes achieved by not having enough product, but also it's achieved by making the price so high that certain people who use copper at the moment will drop it.
Okay, well, Robert Friedland and Ivanhoe and the Western Forelands seem to be doing their best to find new sources of high-grade copper.
Yeah.
But it's not just the copper price that's been hit this year. Lithium has really come off this year, perhaps for the same reasons you were saying about the battery metals, the EV market, not really delivering on its projections, on its forecast.
Yeah, well, we had in China a speculative bubble in the spot price. And the big car makers are not buying in the spot market to satisfy their long-term projections of what they're going to need. So there was some speculative buying there when the Chinese market was in, overheating, frankly. The overheating's now gone because what we saw was that the lithium, there were some high lithium stocks out there, but we did not see the lithium stocks move up to the same extent as the spot lithium price did. But we've seen them all retreat by the amount that the lithium price has retreated, even though it's a spot price which is not driving their economic models. It's not driving the future transactions in the space. When the price was at its peak, most people in the lithium space that were doing PFSs and PEAs were using a price that was a third, a quarter, even less of what the spot price was. But they've all been pummeled despite their conservatism. Conservatism has not paid off for them because the investors have just turned around and saying, the bubble's over, the boom's over, battery metals are over. And, it's all just so black and white, but it's not black and white. It has to be nuanced. And we've got, if anything, a pause in that space, not a collapse.
Well, the automakers are infamous for their ability to drive prices down of their suppliers to get the price point that they want and that they need for their consumers. Yeah. So imagine that's very much the case in the lithium space and the battery space as well. They're putting a lot of pressure on their suppliers. So this is the price point we will accept.
Yes, exactly. And they're constantly threatening the battery sector with changing the formulations. We're going to move to LFP. We're going to move to sodium ion. We're going to do this. We're going to do that. Tesla, Elon Musk is notorious for rattling his saber at the sectors out there that supply him to make them all think that they're expendable, or that he's going to, just sort of crush their desires for stable or higher prices for their product. It sometimes works. Managed to take a bit of wind out of the rare earth market with his, we're going to replace rare earths in magnets, but it hasn't happened. And until he reformats his, what he's putting in his Teslas in terms of batteries, it's a case of do as I do, not do as I say.
Well, he's specifically at Tesla. The company's also invested in mineral supply. And I imagine part of that is having the security supply, but also part of that is to be able to control the marginal cost. If he's got marginal cost pricing, he can apply that upstream to the mineral producers.
I haven't seen him buy into a major lithium producer.
Well,
and he can't buy into the major cobalt producers. He hasn't bought into manganese, and he hasn't bought into nickel. He's just a windbag. And he says he's going to do it, but then he doesn't. I mean, if there's a moment in which Tesla should be entering into the lithium space, it's now, because there's so many bargains around. But they're not. Stellantis is doing a lot more, which is Renault really, is doing a lot more on that front than Tesla is.
Let's switch to uranium. Uranium has been having a very good 2023. What are the key things driving that?
Well, reality has finally kept up with the market. The people in the uranium space have been like the boy who cried wolf for 20, 30 years now. I mean, we're going back farther than Fukushima. The reason why the price was so ebullient before Fukushima was that people said that this crisis was coming, there wasn't enough production, and China and other countries were massively expanding their fleet of nuclear power plants, and there was not going to be the product, and old mines were, going out of action. And they kept saying it, and then Fukushima came along like a massive hammer, smashed the space, and, you just end up like Humpty Dumpty with pieces all over the place. But the underlying story that the promoters, and for once I'm giving credit to the promoters, have been espousing for so long has finally come to pass. There's just not the production there. The plants that were on the drawing board, and so as long as they're on the drawing board, they weren't using uranium. Now they're actually built, almost built, halfway built. And we're not talking about 2 or 3 plants like in the US where virtually nothing's happening. We're talking about China, India, other countries that are massively increasing their footprint in the nuclear power space. And really, we haven't seen the mines to satisfy it. And because once again, as we see in so many mining sectors, you get a big slump, as we've had since Fukushima. The investment money disappears. The capex is constrained, and you don't get the mines built. They stay on the drawing board. So while the plants have been going off the drawing board into reality, the the uranium mines have stayed on the drawing board and are nowhere near reality, because each one of those, there may be a plan, but you've got to get the environmental approvals. You've got to build it. And it's a lot more complicated. So it's going to be really interesting now.
It seems quite a curious moment in time. There's a lot of positive tailwinds for several different mineral sectors, yet it's been really, really tough times for the exploration companies, the junior sector. There's a paucity of investors in many different commodities. Why do you think that is?
Because so many of the junior explorers have not been delivering. If we look at the lithium space, the companies that in 2010, the first lithium boom, did the exploration, advanced their projects even after the price had gone down. So we're talking about Oro Cobre, Galaxy, those type of companies. They kept working away at their projects, whereas everyone else froze their budget. They didn't do any drilling. Then along came 2017 when we had a mini boom in the battery metal space. These companies raced out the juniors, raised more money. They still didn't do any drilling. It's only the ones who have done the drilling and have come up with a resource, come up with a PEA, come up with a PFS, and are sort of oven ready for a buyer, whether it's a big Western OEM or whether it's a Chinese battery manufacturer or somebody like that, POSCO. The ones who've produced a package with a bow on it that is attractive to the buyers have something to sell. The companies out there in the lithium space, and there are a lot of them, that have not drilled a single hole ever. They actually thought that this was like the miracle mineral where you didn't actually need to have drill results. You just need to have lithium in your name. Someone would buy it, and some dumb, enormous Chinese company would come and buy them. And the Chinese companies aren't that dumb. They know more about the industry than any of the promoters ever would. And they know that a property that's had no holes in it is not for them, because they'd have to do the holes. And they're not in the business of drilling holes.
Well, that's in the lithium space. Let's talk about the gold space. A number of juniors have done a lot of work, have put resources on the books, have done economic studies, really work to advance their projects. Gold's at a relatively high $2,000 per ounce, and their share prices are still in the gutter, still getting no love. Well, what's happening there?
I think there's an overpopulation of the gold space, frankly. We need half the companies to disappear. There are too many gold projects out there. And they all think that someone larger than them, and mainly someone very much larger than them, so a mid-tier or major, is going to buy them. And very few of them have discovered anything that a major, like a Barrick, would look at, because they're just not super big deposits. And so a junior comes up with a resource of 1 million ounces and trumpets it to the world. Who's going to be a buyer of that? Someone with 1.5 million ounces might merge with them when they really finally run out of money. But I think also the buyers in this space, so I mean by this, the mid-tier companies, are not paying the type of premiums that they paid back in the previous gold boom up until 2012, where they would pay 100% premiums to take over a company and then find, and Kinross was the most notorious case here, find that there was nothing there, or that what was there was not what they thought was there. So now many of these mid-tier companies are just sitting and waiting until these juniors are so desperate that they have zero bargaining power. and they will take them out.
It sounds like from your comments that you very much think that the juniors have got the wrong strategy. In the past, the mid-tiers have had the wrong strategy.
Yes.
So that being the case, what would you say is the right strategy or is a right strategy?
Well, part of the problem is this dichotomy that's sprung up in recent years, because companies like BHP and, gigantic companies would be out there doing their own drilling and looking for new deposits. Many of these majors have not been doing that themselves unless they found something that was really a mammoth thing that they thought that they could drill themselves and develop themselves. Most of them have just been relying upon basically the bottom fishing juniors to raise money in the capital markets, do the drilling, then do the paperwork, the various approvals, and then all the studies. And then they would come back later when the stock was totally bombed out, and they would offer $200 million to acquire a company that spent $400 million in work. That's a great deal. But the problem is that there's so many companies that have spent $20 million, have spent $40 million, and their market cap is 20, that just aren't on the radar. No matter how much the majors lower their standards, these companies are never companies that are going to be bought by a major.
So it seemed, we talked about before we came on air that there aren't really a lot of investors around, or there's not a lot of investor interest in this space at the moment. Is that, you're a professional investor, so you see that, you believe that the company strategies are the wrong strategy, so
Yeah.
investors at large see the companies as having the wrong strategy.
Yep. No, I agree totally. We have there's a dichotomy between the Australian market and the Canadian market. The Australian market has the super funds. Now, during the period after 2012, even the super funds in Australia weren't investing in the mining stocks. So Australia and Canada sort of looked similar situation. But with the recovery in the broad metals prices from around 2018, 2019 onwards, the Australian managers, and many of these are self-directed super funds in Australia, pension funds they are, decided to come back into mining. In Canada, there's just not that phenomenon. You have people who are sort of hardcore in the mining space, or they're not there at all. And the group, I don't know, out of the population of Canada, how many people what percentage of the Canadian population actually invests in mining stocks? I know in Australia, I would say it's a lot higher. And it's a lot higher partly because of these super funds, because people have money that they need to allocate, and they look in the newspapers and they hear on the news that mining's sexy. In Canada, it's the same old people just regurgitating the money around, and regurgitated money isn't pretty.
I think you could also see that in the marketing approach and the marketing strategies of the companies. They're not necessarily doing anything different today than they would have done 5, 10, 15, 20 years ago.
Absolutely. We're here at this Minds of Money conference, and I was here 10 years ago. Looked pretty much the same. The companies had the same brochures, they had the same banners, the names have changed. Most of the names have changed. But it's the same old sales pitch. It's basically read my presentation, buy my stock. But the population of investors at these conferences has been definitely thinned out. You're almost getting to the stage now there are more companies than investors.
I mean, is that because there are fewer investors per se, or investor fatigue, conference fatigue?
Well, with the rise of the internet, and the internet has really come from nothing in 1995 to where it is now, you can sit at home, do your own due diligence, and you don't actually have to come to a conference. The days when the passages of this conference were thronged with the fund managers coming out of the city, coming 2 miles north to this event and finding something new or novel, are long gone. These people do not leave their offices anymore, and they're certainly not wandering around in here. They expect the companies to come to them, and it's the way of the world, particularly when you're as big as BlackRock. Do you really just sort of schlep around in a conference looking for a $3 million market cap stock? Not even on BlackRock's radar. And these conferences used to have a lot more majors at them and mid-tiers. Now they're almost exclusively juniors. I don't know. I'd be interested to look around and see how many of these stocks here actually have market caps of over 100 million. I'd say virtually none.
Okay. Now, related to that, there's a lot of cheap share prices out there. Depending on who you talk to, there's a lot of value out there. Is it the time to jump in?
I think so. Because it's got nothing to do, gold, despite what people think, it's got nothing to do with inflation. It's got nothing to do with the Ukraine or with the Middle East. It's got to do with cycles and how people feel. And when people, you get a collective sort of mindset that there are bargains out there and the bargains aren't going to get any cheaper, that's maybe a key thing. Because you can wait until they get cheap, but if they're not going to get any cheaper, then you're saying, well, I might as well buy now, because they may go up. And we're starting to see that. We're seeing stocks in totally unsexy metals going up over the last few weeks. And it's just sort of like their time has come. The wheel turns as it does, maybe a bit more like a hamster wheel where you're constantly running and not getting anywhere. But the wheel turns in the mining sector every 5 years or every 10 years for different metals, or for 50 years if it's 10. And then suddenly, the sun starts to shine upon you again. And so I think at the moment, the gold price going above 2,000, holding there for a few days, is a bit like the first swallow of summer, but at the start of winter. So there you go.
So given that all that we've said and talked about today, what would you say is a healthy investment strategy at the current moment in time?
A diversification. Too many investors in Canada are particularly fond of fads. So gold is their perennial, and then they'll put the other 20, 30% of their portfolio into the fad of the day. It's been battery metals, it was rare earths, it was the uranium at the start of the century. They've got to be more diversified than that. You've got to be more sophisticated than just buying gold.
And more patient?
The patience is an evergreen in the mining space. If you don't have patience, don't even go there.
Well, Christopher, thank you very much for joining us today. It's a fascinating conversation.
Thank you very much.
And this is Paul Harris for Kitco Mining at Resourcing Tomorrow in London. And if you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of Resourcing Tomorrow is brought to you by Aris Mining.